Okay, good morning everyone. Today is our last session on Ind-AS 101 that basically deals with first time adoption of Ind-AS. We have to wrap up the standard. It will be a slightly longer session today. Okay, so let us continue. What was the last thing that we discussed uh, in the previous session? Well, we have all in all discussed a couple of things. The first one is the very important definition of first Ind AS financial statements. Then we saw what do we mean by previous gap, and lastly we saw what we mean by the transition date. Then we saw that transition involves four things: basically recognition of items in Ind AS which were not recognized in AS. The second is the opposite of this, derecognition of items in Ind AS which were recognized in AS. The third one is a reclassification, and the fourth one is a remeasurement. So these are the four things which we are going to look at. Specific transitory items, we saw the ESOPs, what is the impact that we do. Then after ESOPs, we have also seen, I think, the foreign exchange transition, that is basically the impact of para 46 and 46A, as well as the FCTR that is there. So we have seen that. And finally, we had come to property, plant and equipment, where we are having retrospectively follow the Ind AS, which is the norm in all the cases. Or you could go ahead for a deemed cost, which could be either the previous gap carrying value or the fair value on the date of transition. So when we talk about fair value on the date of transition, this is specifically not the application of the revaluation model, but it is merely a starting point for Ind AS. It is only a starting point for Ind AS. And after this, we are going to apply the cost model or revaluation model as the case may be. So this was what we had discussed in the previous sessions. And if I recollect, which all questions did we do? That is the next important part. So I presume we had done, okay, I had told you to try some questions. Just let me know which questions did I tell you to try. Okay. And we'll just quickly go through those questions once, and then we shall continue with the further provisions. Okay. If I recollect, yeah. I told you to start trying illustrations 11, 12, 13 or some of those things. How many of us have tried these illustrations? Good morning, Satish. Good morning, Shailesh, Shruti. Good morning. Yes. All right. So let us start the questions. I'm not sure if you have been able to try or not. So we'll anyways go through that and come to know what is the impact. Okay. So Y Limited is a first time adopter. This is illustration 13. Y Limited is a first time adopter of Ind AS. The date of transition is 1st April 20x5. On 1st April 20x1, that is prior to transition. It obtained a 7-year, $100,000 loan. It has been exercising the option provided in para 4646A and has been amortizing the exchange differences in respect of this loan over the balance period of the loan. Okay. It has been amortizing this over the balance period of the loan. All right. On the date of transition, the company wants to continue the same accounting policy with respect to amortizing the exchange differences, whether the company is permitted to do so. Do not look at the solution, please. Okay, so this is illustration 13. Okay. It is amortizing the exchange differences. It is amortizing the exchange differences. That means if I look at my Forex, I had two options. The first option was take the difference to profit and loss account and be done with it. There is no question of amortizing or taking it to the property, plant and equipment if it is an asset based loan that you have taken. ऐसा तो कुछ है नहीं. So what it is doing is it is taking the option of amortizing it. That means basically it is amortizing means what? This is FCMITDA. So in our discussion, it is essentially following option two. It is essentially following option two. That is existing loan getting amortized. Existing loan getting amortized. Okay. So if I look at the conclusion, previous gap, it is going under option 2. That means amortization. In option 2 in our discussions that we had. Okay. I hope you are familiar with this. Option 1, take it to the profit and loss account. Option 2, you had availed para 46A. So if it is a general loan, accumulate it in FCMI TDA, or if it is a depreciable asset loan, then capitalize it and depreciate it over the useful life of the asset. So this is option 2. So it has availed option 2. And therefore, previous gap, they are following option 2. Now the question is, on the date of transition, the company wants to continue the same accounting policy. That means transition also, it wants to go ahead in option 2. You tell me, is it permitted or not permitted? Is it permitted or not permitted? Yeah. What do you think? Previous gap, option 2. Ind AS also, it is asking for option 2. Is it allowed? बोलो यार. Is it allowed? Yes, it is permitted. It is permitted. See, if you are continuing under option 2, you can continue under option 2 in the Ind AS regime also, but only in respect of the existing loans. Only in respect of the existing loans. For fresh loans, you cannot take this option. You will have to go under the profit and loss route. So that is option 1. Now, option 2 I'm doing, I want to go to option 1. Can I do that? Answer is yes. Option 1 I'm doing, can I do option 1 only? Answer is yes. Option 1 I'm doing, I want to go for option 2. That is not permitted. That is not permitted. If you remember, we had done this particular table. Yes. Students don't remember anything. Okay. If you remember, we had done this. So option 1 to option 1 allowed. Option 1 to option 2 not allowed. Option 2 to option 2 is a transition relief which is allowed only for loans existing on the date of transition. Option 2 to option 1 is allowed because that is basically you're falling in line with the Ind AS. So this is something which we had already discussed. So are you permitted? Answer is yes. Are you permitted? Answer is yes. Okay. So with that, let us move on to the next one. Illustration 12 we will try. Y Limited is the first-time adopter of Ind AS. The date of transition is April 1, 20X1. On the date of transition, there is a long-term monetary foreign currency liability. That means a loan. Okay, that means a loan of 60 crores. That is $10 million converted at the exchange rate of $1 equals rupees 60. This 21 is a printing mistake. The accumulated exchange difference on the date of transition is nil, since Y Limited was following AS 11 notified under the company's accounting standards rules and has not exercised the option under paragraph 46 or 46A of AS 11. That means, tell me, under previous gap, which option is it following? Under previous gap, which option is it following? Quick. Is it following option 1 of taking it to the P&L, or is it following option 2 of amortizing the exchange differences through the FCMI TDA, or depreciable asset capitalization and thereafter depreciating it over the tenure of the fixed assets? What exactly is the company doing? Is it following option 2 or option 1? Bolo, tell me. This is illustration 12. Previous gap. Which option is it following? Yes, it is following option 1. Now, The company wants to avail the option under para 46A of AS11 prospectively or retrospectively on the date of transition to Ind AS. How should it account for translation differences in respect of this item under Ind AS 101? It wants to now, on the date of transition, it wants to avail the option given under para 46A. मतलब जब AS11 था, when AS11 existed, it did not avail para 46A. But when it is going into Ind AS, it wants to avail para 46A. By how can it do that? Okay, one, to Ind AS does not recognize para 46A. You did not avail it under AS. You want to avail it under Ind AS. So it wants to move from option 2 to from option 1 to option 2. Okay, on transition, it wants to go ahead to option 2. Movement from option 1 to option 2, is it allowed or not allowed on transition? Not possible. So that is exactly how should it account for the translation differences? Take it into the profit and loss account. There is nothing that can be done. There is nothing that can be done. Okay. So you can see the solution. Company cannot avail the exemption given in Ind AS 101 and cannot exercise option under para 46, 46A of AS11 prospectively. Retrospectively का बात करेंगे sir. I will do it right from the beginning. Did you do it under AS11? Answer is no. So how can you do it under the transition provisions? So the company cannot avail exemption and cannot exercise the option retrospectively. Okay, because the option is available only if it is in continuation of the accounting policy followed in accordance with the previous GAAP. You cannot say, I will change the accounting policy of what has been done under AS now on the date of transition to Ind AS. वो नहीं कर सकते आप, तो वो आप नहीं करोगे. You will have to continue with taking the differences to the profit and loss account. यार उस time पे when your exchange differences were so violent, you did not even change. You said, I will take the hit and continue. Why do you want to take? Why do you want to modify that option availed right now? You cannot exercise that option, and therefore that is not allowed. Okay, so illustration 12 also is done. Okay, 12 is done, 13 is done. Coming to the next one, question 3 on page number 14.47. This is your test your knowledge. Okay, all right. Y Limited is a first-time adopter of Ind AS. See, you are able to see all these 3-4 questions which we are doing. The language is very similar. The language is very similar, but for small points, small points here and there, your question largely looks similar. That is why I told you, if you are doing such questions, read once, twice, thrice before coming to a conclusion. Otherwise, you will say, what is the difference between these three? Differences are there. Differences are there. Good morning, Mohammed. Good morning. Yeah. So coming to question 3, Y Limited is a first-time adopter. The date of transition is April 1 X5. On 1st April X0, it obtained a 7-year US $100,000 loan. It has been exercising the option provided in para 46 or 46A of AS11 and has been amortizing the exchange differences in respect of this loan over the balance period of the loan. That means previous GAAP, it is following option 2. On the date of transition to Ind AS, Y Limited wants to discontinue the accounting policy as per previous GAAP and follow requirements of Ind AS 21. That means it wants to take the exchange differences to the profit and loss account. So is the company permitted to do so? From option 2 to option 1, it wants to come. So now you tell me, is it allowed to do so under the, what you can say, under the transition provisions? Is it permitted? Bolo. Yes, it is permitted. Okay, it is permitted. All right. So quickly we did see the case is the same in all the three, but only thing is they have made slight changes towards the options which are being exercised. So you'll just have to be careful with that. You will just have to be careful with that. All right. Now. Coming to Okay. X Limited is the holding company of Y Limited. Okay. X Limited is required to adopt Ind AS from April 1. X wants to avail the optional exemption of using the previous cap carrying value in respect of its property, plant, equipment, whereas Y wants to use fair value of its property, plant, of its PPE as its deemed cost on the date of transition. Whether X can do so for its consolidated financial statements, also examine whether different entities in a group can use different bases for arriving at deemed cost for PPE in their respective standalone financial statements. Okay. So this is illustration 8. Okay. This is not foreign exchange, this is assets. Okay. Assets ka rule kya hai? What is the rule for assets? Well, first one is you can do a retrospective restatement. That means go back in time, follow Ind AS provisions, like if you have to create a site restoration obligation provision, create that. Do componentization, do basically everything that Ind AS 16 wants you to do right from the date of acquisition of asset. Depreciate, and bring it to the carrying amount on the date of transition. On the date of transition, you compare the carrying value as per previous cap, which is already there with you, versus the carrying value as per the Ind AS retrospectively computed by you. May take the difference will go in the retained earnings, and you will have the fresh value of your fixed assets or property, plant, equipment in accordance with retrospective restatement. So that is the mehnat wala option, the hard working option. That is the first option. The second option is you can go for a deemed cost. Now, what do you mean by deemed cost? Here again, the standard gives you two options. Take the previous gap carrying value as the deemed cost and move forward. Don't take any efforts, which is what in fact most companies do. Coming to the second option, instead of going for the previous gap carrying value, which you feel is not giving a true and fair value, you can go for the fair value on the date of transition, with the difference being taken to revaluation reserve or retained earnings, as the case may be, because this is only a transitory provision. So therefore, this is the deemed cost. Now, in this question, what they are saying is X wants to avail optional exemption of using previous gap carrying value. Okay, so X wants to go for previous gap. Y wants to use fair value. Y wants to use fair value. Okay. ठीक है, but both are using the deemed cost exemption. But what is important to notice, X is the holding company of Y. Okay, subsidiary. Parent relationship. Okay, now I want to ask you, is this permitted? Is this permitted? Yes. Is this permitted? Okay. Yeah. X wants to go for the deemed cost adjustment under the previous cap, and under the previous deemed cost, that is the previous cap carrying value. Y also wants to adopt the deemed cost, but at fair value. Both are permitted under Ind AS 101 transition. The question is, X is the parent, Y is the subsidiary. You have studied consolidated financial statements and you have also studied business combinations. तो आपको parent subsidiary relationship का idea है. You also have the idea of the transition provisions, and you are also having an idea of what the parent wants to do and what the subsidiary wants to do. I want to ask you, is X permitted to go for the previous cap carrying value, and simultaneously is Y permitted to go for fair value on the date of transition? Is it permitted or not? Yes, is it permitted or not? Think and answer. Yeah, I'll go a little slow. It's basically something which you have already done. So that is why. I just went through. All right. So now tell me, is it permitted or not permitted? Okay. So, okay. Very good. Very good. I'm not seeing Shankar. I'm not seeing Tanisha today. Okay. Fine. Namrata also is not there. Okay. Fine. So coming back. Yes, it is permitted for separate financial statements. It is permitted for separate financial statements because X is a standalone entity by itself. Y is also a standalone entity by itself. So, in their separate financial statements, X can very well avail the option of previous cap carrying value, and Y simultaneously can avail the option of fair value. However, if I go for consolidation, which X Limited will have to prepare, then for the purposes of consolidation, I cannot have two bases. I cannot have two different bases of accounting. So, kiska change karoge aap? What are you going to change? Are you going to change X or are you going to change Y? What are you going to change? What are you going to change? What are you going to align? Are you going to align X with Y or Y with X? You have to align Y with X. For CFS, for consolidated financial statements, different basis not permitted. Restate Y using previous cap carrying value. This is for maintaining consistency. Is it okay, Prashant, Shailesh, Satish? Is it fine? Yes, all right. Okay, that's great. So we are done with illustration 8. We are done with illustration 8. Okay. Coming next, illustration 9. For the purpose of deemed, okay, those who want to write can just write this down. Okay, coming to the next one, illustration 9. For the purpose of deemed cost on the date of transition, an entity has the option of using the carrying value as the deemed cost. Okay. In this context, suggest which carrying value is to be considered as deemed cost. That is, should it be the original cost or the net book value? Also examine whether this would have any impact on future depreciation charge. Bolo. Illustration 9. What is previous gap carrying amount? Is it cost or is it net book value? Is it cost or is it net book value? Net book value, that's absolutely right. It is the net book value. That means what you are going to do on the date of transition is you will actually pass an entry transferring the accumulated depreciation the accumulated depreciation, which is there in the books, you will actually pass an entry debiting that and moving it to the gross block. So the gross block itself will get restated to the net block, and that will be the basis for accounting. That will be the basis for accounting. Yeah, very interesting. Okay, let me deviate a little bit. Okay, let me just deviate a little bit. See, suppose we are in the year 2023-24. How many of anybody has actually done transition in their articleship? Have you guys actually done transition of any of your clients to Ind AS during articleship? Yes, Mohammed, Mansha, Prashant, Shailesh, Satish. Have you guys done worked on transition assignments? No. Okay, fine. Let me just explain, since this is a very peculiar thing. Okay, you can also think about it. Okay, I'm not saying what I propose to say here is the only right thing, but just think about this. Okay, just think about it. See, what happens is, suppose this is the year when Ind AS becomes applicable. You have to do a comparative of 22-23, and you have to prepare a balance sheet on 1/4/2022 also. You have to prepare a balance sheet on 1/4/22 also. See, what all we do is academic. I definitely respect that because it's very crucial. You have to know the provisions of the standards first. But let us now come to the situation. Okay. And this is where things start getting really interesting. Okay. And this is one of the challenges you may face, you may end up facing. Okay. See, I have my property, plant, equipment. I'm taking one example. You can take multiple examples. You can take multiple examples. Okay. First one, I have gross block less accumulated depreciation. So that gives you net block. That gives you net block. Fair enough. Now, what we are adopting is, we are availing the previous gap carrying value. We are availing the previous gap carrying amount. Okay. Now, these are actually separate accounts. You imagine a company with a turnover of a couple of hundreds or thousand crores. Just imagine the kind of assets it will have. It will have multiple line items of assets. It will have multiple line items of asset accounts and multiple line items of accumulated depreciation for asset accounts. Okay. वो normal है. It is normal. But now you are in the year 23-24. Don't forget that. Okay, don't forget. I am on this year and I have to work back for 1/4/2022. When I talk about previous gap carrying amount, I actually mean the net block. I actually mean the net block. That means where should I reach is my gross block should be this. Less accumulated depreciation should actually be 0 for me to arrive at the net block. That means I actually have to pass an entry transferring this to this, transferring accumulated depreciation items to the gross block. Now, my question to you is, and you can think about it, I am in this year. I am in the year 2023-24. I have to do the adjustments on 1st April 2022. Now, 1st April 2022 is essentially nothing but 31st March 2022. 31st March 22 audit is already done. Yes or no? Audit is already done. And because audit is already done, the books of accounts are stated as being in agreement with the financial statements. These books of accounts are stated as being in agreement with the financial statements. It should become zero because, Shruti, I am actually requiring to transfer the accumulated depreciation block item to the gross block. See, when I purchase an equipment, I pass the entry PPE account debit to cash bank or creditors. Okay. And when I depreciate, I pass the entry depreciation account debit to accumulated depreciation. Now, why I do it like this? This is the requirement of the Companies Act. I have to show the gross block separate. I have to show accumulated depreciation separate, which will give me the net block. वो सीपीटी एंड इंटर में आप लोग पढ़ते थे फॉर नॉन कॉर्पोरेट एंटिटीज डेप्रिसिएशन अकाउंट डेबिट टू प्रॉपर्टी प्लांट इक्विपमेंट दैट इज नॉट परमिटेड अंडर कंपनीज एक्ट. You have to show gross block separate, accumulated depreciation separate, and the net block will be the difference between the two. Now, on the date of transition, what Ind AS tells us is you can avail previous GAAP carrying value. That means when I move from AS to Ind AS, the PPE amount, the property plant equipment amount, is equal to the carrying amount. That is the WDV. And what is the WDV? The WDV is gross block minus accumulated depreciation. But sir, these two things are actually in different accounts. These two things are in different accounts. If you are the auditor, you know that these are two different accounts. Will you certify by saying that I bring both these accounts into Ind AS? Answer is no, you cannot. Ind AS requires the opening cost. It is deemed cost. It is not deemed carrying amount. If you see the provisions of Ind AS 101, it is deemed cost. And deemed cost adjustment is saying that you can take previous GAAP carrying value. You can take previous GAAP carrying amount. So when I talk about deemed cost, I actually have to say that the gross block is equal to the carrying amount as per accounting standards. And what is this carrying amount? This is gross block minus accumulated depreciation. That means you actually have to do a transfer entry of accumulated depreciation account debit to property, plant, and equipment. And you will end up making the accumulated depreciation zero, and the property, plant, equipment will now be recorded at which value? The accumulated, the PPE will now be accounted at the deemed cost, that is the carrying amount as per the previous GAAP. Have you understood, Shruti? Yes. So now coming to our case, coming to the case which I was discussing. See, on 31st March 22, you have certified your financial statements as being in agreement with the books of accounts. That means, please listen carefully. In the 31st March 22 balance sheet, there is a gross block, there is an accumulated depreciation and a net block. The same thing also continued for 22-23 also. But when I do a restatement, when Ind AS becomes applicable to me, I have to go back in time and move this amount to the property, plant, and equipment. Now, can you imagine, there are hundreds and thousands of line items of assets. There are hundreds and thousands of items of, what you can say, accumulated depreciation. Matlab, you have to go back in time, open the accounting period, pass these transition entries, close the accounting period, and then make the adjustments in 22-23, and then come to 23-24, and then you will come to 23-24. Now the problem here is, these documents, understand this balance sheet, when you were finalizing, it is on the basis of this balance sheet that you have filed your income tax return. It is this balance sheet that has gone to the Ministry of Corporate Affairs. It is this balance sheet that has gone to the investors. It is this balance sheet that is being analyzed. It is this balance sheet which is audited. And now you have to go back in time and change these figures. You have to go back in time and change these figures. That means unless you have a robust IT solutions with you, unless you have a robust system with you, where you can take a backup of these balances and you can submit it to the income tax or MCA as and when they require. Suppose your case is picked up for income tax scrutiny for 22-23. 22-23 ka scrutiny will never come in 22-23. It will come earliest in 23-24 with the proceedings that could go until 31st December 24. I mean, this is what I remember from my past exposure in the income tax. Okay. It may have changed now. I'm not much of an expert in the tax provisions. But yeah, what I remember was you have to complete it by 31st December 23 is what I kind of recollect. I may be wrong. Okay, 23 or 24. Okay, 24 I suppose. Okay, because you file the return for 22-23 by October 23 or November 23 if transfer pricing is applicable. Thereafter, you have time to get the notice. So I think, yeah, by 31st December 24, you have time to complete the scrutiny. So invariably, your scrutiny proceedings will be happening in the year 23-24. And in the year 23-24, when they ask for data from you, you cannot give the 22-23 data directly from the live system, because the live system has already been modified to incorporate the Ind AS adjustments. Dekho, in Ind AS, you are not only changing current year, you are changing the previous year also. But वो income tax को नहीं समझ में आता. Income tax fellows will not come to know. MCA फिर भी समझ में आ जाए. Income tax people will never come to know this. You submit this balance sheet to them. वो बोलेंगे ITR में you submitted something else, sir. Now you are submitting something else. That means you have evaded income tax. Matlab, the thought process goes in that direction only. But in fact, is that what you have done? No, that is not what you have done. You have only done a retrospective adjustment. You have only done a retrospective adjustment because of the requirements of change in your accounting, change in your regime. And therefore, you need a robust system to first take a backup of the 31st March 22, 22-23 and store it separately, because that is the balances which you have filed your statutory, which you have done your statutory filings. And then you proceed to make the system changes for the previous periods and then move on to the Ind AS regime. Okay. So the transition impacts are totally having a big implication for an entity. It is not something which happens day in and day out. It is something which is a once in a lifetime activity. And once you move to Ind AS, you cannot say, nahi yaar, Ind AS is very difficult, I will go back to accounting standard. No. Once you come to Ind AS, you are in here to stay with Ind AS. Okay. So therefore, this is a once in a lifetime activity that happens. It is a major change that happens, and therefore it will have a ripple effect in the prior period financial statements also. Sir, if I don't restate, I will only make the changes in my Excel balance sheet. How will you expect the auditor to certify that the books are in agreement with the financial statements? Because the financial statements, he will actually restate not only the, he will actually give his opinion not only on the current period, but also on the comparative previous period and the beginning of the earliest reporting period. So, if both these columns are not as per books of accounts, how can you expect the auditor to certify that the books are in agreement with the financial statements? You remember na, that section 43, as per the requirements of section 143, the auditor has to certify 1, 2, 3, 4. There are about 10 to 12 items in the audit report. One of those items is we certify that the books of accounts are in agreement with the financial statements. How can you expect the auditor to certify this if you have only done the changes in the Excel sheet? Number one. Secondly, if I don't make these changes 23, 24 and onwards, how can I actually go ahead with Ind AS? For example, a site restoration obligation provision was not required to be made under AS regime, but it is required under Ind AS regime. And therefore, you need to have the site restoration obligation appearing on 1st April 22 and 31st March 23, जो कि था नहीं, but अभी डालना है अपने को. And therefore, you will end up making an adjustment in the previous period's balance sheets. Okay. So it is a very complicated exercise. If at all you are going, if you at all you want to experience how this happens, please look for an Ind AS transition assignment. Okay. Anything that comes up in your organization or even after you qualify, there is no thing that you have to do it right now. But my sincere request to you is, if you actually find this whole financial reporting as a very interesting area, my suggestion is look for a transition assignment in your professional career. It works wonders. It works wonders in the way you can interpret not only the transition provisions, but also the Ind AS applicability thereafter. Okay. So that was the small deviation that I took. Coming back to our discussions. Coming back to our discussions. Yeah. So would this have any impact on future depreciation charge? Well, per se, just moving the accumulated depreciation to the gross block, it will not have any impact on the future depreciation charge. But if there is a change in the life or there is a change in the salvage value, there could be a change in the depreciation charge. There could be a change in the depreciation charge. So that takes care of illustration 9 for you. Yes, that takes care of illustration 9. Coming to the next one. Question 2. Question 2. Okay. X Limited was using the cost model for its property plant equipment till 31st March 20X2. Ind AS became applicable to the company for financial year beginning April 1, 20X2. On April 1, 20X1, that is the date of its transition, it used fair value as the deemed cost in respect of its transition to Ind AS. Okay. So on the date of transition, it opted the deemed cost exemption, and under the deemed cost exemption, it took the fair value as the deemed cost. It did not go for retrospective restatement. It did not go for previous cap carrying value. It went for the fair value. Now, X Limited wants to follow the revaluation model as its accounting policy in respect of its property, plant, and equipment for the first annual Ind AS financial statements. The question is whether use of fair values as the deemed cost on the date of transition and use of revaluation model in the first Ind AS financial statements would amount to a change in its accounting policy. Would amount to a change in accounting policy. Read the question and tell me. Read the question and tell me. Yes. Okay. Okay. So, uh, use of fair values on the date of transition. If the question stopped here, if the question stopped here, then merely opting for deemed cost and using the fair value will not say that it is a revaluation account, revaluation model. Because what you are doing is you are giving a starting point to Ind AS. So therefore, if the question stopped here, it would not have been an accounting policy change. It would only be a balances recognition, and going forward, the cost model only would have applied. But what they are saying is whether use of fair values, and they say that it wants to follow revaluation model as its accounting policy. It wants to follow revaluation model as its accounting policy. So now it is using fair value at the transition date as well as in the first Ind AS financial statements. There is no change in the accounting policy. And mere use of the term deemed cost would not mean that there is a change in the accounting policy. There is no, yes. So it is not a revaluation model. It is not a revaluation model. All right, and use of revaluation model in the first Ind AS financial statements. It is not saying subsequently. It is not saying subsequently. Use in the first annual Ind AS financial statements. In the first. After that, it wants to continue regularly. That means cost less depreciation. So therefore, this is not going to be a revaluation model. But suppose they say that whether use of fair values as deemed cost and use of revaluation model in the first and subsequent financial statements. If this was given in the question, yes, it would amount to a change in accounting policy. But this is not given in the question. And because this is not given in the question, it is only for the purposes of the first annual Ind AS financial statements. It will not be a revaluation model. It will be a cost model that is being followed. And this cost model allows you to take the fair value on the date of transition in line with the guidance provided under Ind AS 101. Are we clear, Namrata and Shruti? Are we clear? Yes. Are we clear? Yes. All right. समझ में आ गया. So that is done. Coming to the next one. Okay. All right. Question 4. A company has chosen to elect the deemed cost exemption as per Ind AS 101. However, it does not wish to continue with existing policy of capitalizing exchange fluctuation on long-term foreign currency monetary items to PPE. That is, it does not want to elect the exemption available as per Ind AS 1. Okay. In such a case, how would the company be required to adjust the foreign exchange fluctuation already capitalized to the cost of property, plant, and equipment under previous cap? Okay. Two things are being mixed. Okay. First one, property, plant, equipment. This is cost plus forex capitalized less depreciation. Okay. So this is the previous cap. Now, previous cap forex gain or loss. What are you doing? Sir, I am capitalizing. Sir, I am capitalizing. Okay. Now, transition. Transition. What does it want on transition? Deemed cost. That is previous carrying value. Previous carrying value. Sir, what do you mean by previous gap carrying value? That means जो है वो लेके आगे बढ़ेंगे. Okay. Whereas here no capitalization. It does not wish to continue with existing policy of capitalization. That means it does not want to elect the exemption available as per Ind AS 101. Okay. So therefore, no capitalization of forex gain or loss. No capitalization of forex gain or loss. Okay. Now, the question is how to go about with the forex fluctuations already capitalized. Okay. So now there are two things. One is PPE, previous cap carrying value, which includes foreign exchange capitalized already under the previous cap. But under the forex requirements, it wants to go ahead with no capitalization. It wants to go ahead with no capitalization. It basically wants to say that all my forex gains or losses, I will charge it off to the P&L. So, एक तरफ बोल रहा है I take previous cap carrying value where it is capitalized, and second place it is saying I will not capitalize. Are you able to see a conflict between these two? Are you able to see a conflict between these two? Because when I go for previous cap carrying value, I am capitalizing whatever is there. But when I say forex, I will not capitalize, then you will not capitalize. So therefore, both of them are in conflict with each other or not? Are they in conflict or not? That's right. It means P&L. It means P&L. So now you tell me, are they in conflict or not? Because forex, it is saying no capitalization. PPE is taking the capitalization till date. So there is a conflict. Yes or no? There is a conflict. There is a conflict. And because there is a conflict, how do I interpret? एक बात बताओ मुझे. Tell me one thing. If I look only at PPE, forget forex gain loss. Am I going as per Ind AS 101? Am I going as per Ind AS 101? Yes. Forget previous gap. Forget forex gain or loss. Forget gain or loss. If I go as per PPE, PPE already includes capitalized amounts. So therefore, if I take the deemed cost, am I violating Ind AS 101 or am I in accordance with Ind AS 101? बोलो, forget this. इसको भूल जाओ. Am I following Ind AS 101 if I go for deemed cost, that is previous gap carrying value? बोलो. Forget all this. Okay? बोलो. By going for previous gap carrying value, am I doing anything in violation of Ind AS 101? Yes, this is as per Ind AS 101. Okay. And now इसको देखते हैं. Forget PPE. Forex gain or loss. Previously, I was capitalizing. Now I said no capitalization. That means from option 2, I am moving to option 1. Is this allowed under the transition provisions? Am I violating the transition provisions? Am I violating the transition provisions? Come on. I was following option 2. Now I'm following option 1. Am I violating? Allowed. Allowed. So, if I look at both of them independently, if I look at both of them independently, I am following the transitionary guidance which is there under Ind AS 101. But now the question is, if I look at both of them together, there is a conflict. There is a conflict. So therefore, how do I resolve this? How do I resolve it? Is the question. So what the standard tells us, you have to be harmonious in your interpretation. You have to be harmonious in your interpretation. When the previous gap required capitalization, and in the current gap, you have said no capitalization of forex gain or loss, then you will have to take it as something that will happen now and forward. In respect of assets where the exchange gain or loss has already been classified, where exchange gain or loss has already been classified, then at that point of time, you cannot say that I will go and change that also. Because that is something which is permitted till date. तो वो वैसे ही रहेगा. And when I go for previous cap carrying value, I will take that also. I will take that also. Is it okay? Yes. But in the current gap, in the current regime, what you could do is you could go ahead and say, I'm not capitalizing my forex gain or loss, but whatever was there on the date of transition in the property, plant and equipment, the same continues to remain there. Are we clear with this? Yes. Are we clear with this? Anybody has any doubts? So harmoniously, when I interpret, it means that whatever is capitalized till date, let it continue to remain there. There is no problem. Going forward, I should not capitalize. Going forward, I should not capitalize. So that is your answer to question 4. That is your answer to question 4. Are we clear with this? Are we clear? Yeah, just give me a minute. it is in line with the provisions. Okay, so previous gap आपने capitalize किया, ठीक है, no problem. We'll continue with that. And as far as the forex gains or losses are concerned, okay, no problem. We will continue with that also from now on. Both of them will coexist with each other. Suppose I had to opt for retrospective restatement. That means I'm not availing any exemption. I'm not availing any exemption. Suppose I had gone for a retrospective restatement. What would you have done? What would you have done is you would have required to remove that capitalized foreign exchange, the corresponding depreciation, and transfer it to retained earnings, because you are going back in time and applying Ind AS right from the beginning, which is basically very cumbersome. Okay, koi karega nahi wo. Yes, so that takes care of question number 4. Coming to the next part. Okay, now let us discuss something which you have recently studied. So we have completed 3 items. First one was ESOPs. Second one is forex gain or loss. Third one is property, plant and equipment. Okay. Now the fourth special transitory items, we look at business combinations. We look at business combinations. Okay. Okay. You guys have studied business combination in AS 103. We had corresponding 2 standards under AS 14 and AS 21. Yes, AS 14 accounting for amalgamation, AS 21 that is consolidated financial statements. Okay, so what is the change? What is the change? Let us understand. Okay, I had supposed entity X had invested in entity Y 1000 equity shares, 100%. Okay. Now, I have an entity Z. Z is holding 10,000 optionally convertible debentures, convertible at the option of the holder, and convertible in the ratio of 1:1. Convertible in the ratio of 1:1. And this is held since 2012. This is held since 2012. Z is transitioning to Ind AS. Z is transitioning to Ind AS. So the date of transition is 1st April 2021. 1st April 2021. Now, under AS, who is the parent? Under accounting standard, who is the parent? Yeah. Under AS, who is the parent? Is X the parent or Y the parent? X. Brilliant. You guys are awesome. Under AS, X is the parent. Sir, why is X the parent? Because X is holding greater than 50% of the shares. X is holding greater than 50% of the shares. Under Ind AS, who is the parent? Under Ind AS, who is the parent of Y? Under AS regime, who is the parent of Y? Under AS regime, who is the parent of Y? X is the parent of Y because X is holding 100% equity shares of Y. Under Ind AS, who is the parent of Y? Who is the parent of Y? Who is the parent of Y? सोच समझ के जवाब दो. Okay. Think and answer. Don't give an answer without thinking. Okay. Joint control कैसा होगा? How can we have joint control? There is no agreement between X and Z for jointly controlling Y. See, joint control happens with an agreement. यहाँ पे हमने agreement तो किया नहीं. There is no information given to you, so joint control is ruled out. Come to the definition of control which you have studied under Ind AS 110. Control is basically the ability to direct relevant activities. It is the ability to control the relevant activities of Y, and it with that you get the power over Y, the power to direct the relevant activities of Y. Number one. Number two, even you will consider potential voting rights if they are substantive. So if you have a good reason to convert these OCDs into equity shares, you might as well convert. And therefore, though X holds 100% of equity shares of Y, he has to go to Z for every decision, because if any decision is not in favor of Z, Z can say, I will convert 200 of my OCDs into equity shares and I become the parent. Yes. So therefore, at any point of time, Z is having a stronger power over Y than X has. And therefore, for the purposes of Ind AS, it is Z which is the parent. Now, under AS, X was preparing the consolidated financial statements. Yes or no? So if A was preparing the CFS, A was recognizing the assets and liabilities of, X was recognizing the assets and liabilities of Y. X was recognizing the goodwill on consolidation. X was recognizing the minority interests. Yes. But under Ind AS, किसको करना था ये सब? Who had to do all this? Sir, Z had to consolidate. Z had to recognize assets and liabilities of Y. Z had to recognize the non-controlling interest. Z had to consolidate the profits of Y earned by Y after the date of acquisition. And therefore, have you done that? Answer is no. Sir, हम कैसे करेंगे? How can I do? AS never told us to consider optionally convertible debentures in assessment of control. AS always told, look at existing share capital. And when I looked at my existing share capital, I came to know that X was the parent. But Ind AS बोलता है नहीं, Z is the parent. Now, suppose there is no exclusions or no transition guidance, nothing is given. Let us suppose this were acquired since 2012. Let us assume 1/4/2012. So what you have to do, Z is transitioning to Ind AS. So Z has to go way back in time 10 years ago 1st April 2012. And after going back in time, it will have to compute the fair value of assets of Y as on 1st April 2012. It will have to determine the PC. It will have to determine the net assets. And after determining the PC and the net assets, it will have to calculate the NCI, and then it will have to repeat these computations year after year. It will have to repeat these computations year after year until it comes to 1st April 2021, where we can show that this is the business combination, where we can show that this is the impact of business combination. So basically what we have to do is go back in time, find the purchase consideration, find the NCI, reinstate the goodwill in the books of said, and finish it. Are we clear with this? Yes. Are we clear with this? Yes. Are we clear with this? Yeah. If there is no transition guidance, I have to go right from 1/4/21. Compute profits attributable to Z, compute the NCI, and then, second year, third year, fourth year, every time. Yes, are we clear? If there is no transitory guidance, but there is a transitory guidance. There is a transitory guidance. You can select a date. You can select any date of your choice. Any business combination prior to that date, you need not restate. Any business combination after that date, you will have to restate. Sometimes you may have such dirty acquisitions which may have happened by you that you do not want to disclose it separately. You do not want to disclose it separately. And therefore, the standard gives you some kind of a what you can say, it gives you some kind of a guidance. What is that guidance? The standard says pick up a date. Anything prior to that date, please don't calculate. Anything after that date, we will have to do the what you can say, restatement. We will have to do the restatement. Are we okay with this? Yes. Are we okay with this? Restatement matlab take all assets and liabilities of Z, do the fair valuation exercise, computation of the purchase consideration, and finally you are going to have your purchase consideration, and finally you will have the goodwill that is restated. Are we clear with this? Yes. Are we clear? Hmm? All clear? So suppose I say that from 1/4 2019 onwards, I will recognize the business combination. Okay, so anything prior to 1/4/19, do not even think about it. Okay, do not even think about it. Anything after 1/4/19, you have to take all the business combination. You cannot be selective in your approach and say, I will take only those business combinations which are beneficial to me as the reporting entity. Answer is no. That's not there. Are we clear with this? Yes. So anything after 1/4/19, add it. Anything before that, do not. Yes. Are we clear with this? Yeah. Are we clear with this? Yeah. See, this retrospective restatement is there for all items. But in the case of business combination, there is a selective approach of retrospective restatement. Sir, what do you mean by selective approach? What do you? Yeah, sir, what do you mean by retrospective restatement? Going back in time and applying Ind AS. Now, if I look at property, plant, and equipment, I have to go back in time, find out those invoices when it was acquired, blah blah blah, do everything till the current date. Componentization हो सकता है, site restoration obligations it could be, finish everything and come to the what you can say, and come to the value on the date of transition. But only in the case of business combination, you are given the option to put a date. You are given the option to put a date. Okay. This is assumed. This is assumed. Okay. Assume that 1/4/2019. Prior to that, you are not restating anything. And 1/4/2019 onwards, you are going to restate it. So after 1/4/19, all the business combinations you will have to take. Before 1/4/2019, you will not take anything. But you cannot be selective in business combination. You cannot say Z acquiring Y beneficial, show it. Z acquiring B not beneficial, do not show it. You cannot dictate the terms like this. You cannot dictate the terms like this. Are we clear? Are we clear with this? Yes. Are we clear? Yeah. Yeah. So this is an assumed date, Mohammed, just for our discussion purposes. Okay. All right. Fine. If you go for retrospective restatement, then what you will have to do? Fair valuation of all your net assets. Second one is fair value on date of acquisition, goodwill on date of acquisition. Goodwill on the date of acquisition. Are we clear with this? Yes. You will have to go back in time and restate all these figures. Okay. You will have to go back in time and restate all these figures. Are we clear with this? Yeah. Are we clear with this? Yeah. Very, very humongous exercise, a very big exercise. And therefore, what many companies do is they will not opt for retrospective restatement or even prior to that. Whatever is there is there. You will take the deemed benefit. You will take the deemed benefit. That is basically the date of transition will be the date of your business combination. So whatever is your assets, liabilities, etc. of all the group entities, they are going to be taken as it is. You will not make any adjustment to that. You will not make any adjustment to that. Is it okay? Yes. Because if you go for retrospective restatement, then apart from this, NCI also will change. NCI also will change. Are we clear with this? Yes. Yes. So that takes care of business combination. That takes care of business combination. Okay. All right. So let us look at a couple of questions before we move further. Okay. Okay. All right. Ind AS requires allocation of losses to NCI. You would have studied this, which may ultimately lead to a debit balance. This also you would have studied. Even if there is no contract with the non-controlling interest holders to contribute assets to fund the losses. Whether this adjustment is required to be made retrospectively. Whether this adjustment is required to be made retrospectively. Yeah. Now, in case entity elects not to restate, it depends on when business combination is restated. When business combination is restated. If you don't opt for restatement, if you want to continue with whatever is there into the current year, bring it. That will be your opening business combination value of the assets, liabilities, NCI, goodwill, etc. And going forward, we are going to take those values only and move forward. So it depends on whether you are opting for a business combination restatement, whether you are opting for a business combination restatement. Are we okay with this? Yes. Whether this adjustment is required or permitted, well, uh, that depends on when the business combination is actually uh, you know taken into account. Are we clear with this? Yes. So in case an entity elects not to restate past business combination, then measurement of NCI to follow from the measurement of other assets and liabilities on the date of transition. On the date of transition. Okay? Yeah. So that was illustration 4. We'll just write it briefly here. NCI restatement depends on choice of restatement for business combination. If If past business combination is restated, NCI will be if past business combination not restated, if past business combination not restated, NCI cannot be restated. NCI cannot be restated. Okay? All right. See, this is my date of transition. Let us suppose this is 1/4/2022. You did a business combination on 1/4/2019. Before that, now the question is, what do I do with this business combination? See, between this period, what all you would have done? आपने business combination किया था, that means between this period, you would have added NCI, you would have added net assets. Third one, you would have recognized goodwill. You would have recognized goodwill. Now, this is a loss-making unit. This is a loss-making unit. And because it is a loss-making unit, what is the impact is your NCI would become zero. Your NCI would become zero under accounting standards. NCI matlab minority interest. And below zero, it could not become negative. Below zero, it could not become negative because it was a liability there. It was a liability there. Here it is an equity. So therefore, it did not become zero. In other words, it went on eating the losses जितना उसका शेयर था, and after a point of time it said I have come to zero. अब मेरे पास पैसे नहीं है loss meet करने का, so the losses will then be transferred. Whatever is left out, the losses will be met by the ultimate shareholders. The losses will be met by the ultimate shareholders. ठीक है? Ind AS में वैसा नहीं है. NCI negative है तो है भाई. You are negative. No problem. We are going to show you as negative. Yes. So therefore, 1st April 19 से लेके 22 तक you would have added your NCI for 3-year profits. You would have added some amount of net assets, and you would have also recognized the goodwill. If I do not restate this, and I come to the date of transition, no restatement. No restatement. If there is no restatement that happens, then what you are going to do? Accept values of goodwill, NCI, and net assets from previous cap. But suppose you are having a restatement of this business combination. That means you go back in time and apply Ind AS. Suppose you go for restatement. Then what is going to happen? NCI will change. NCI will change, number one. Second one is net assets will change and goodwill also changed. See, NCI changes, net assets changes automatically. Your goodwill also has to undergo a change. Are we clear with this now? Yes. Namrata, are you clear with this? Yes. So basically, the point is, what does the question ask? The question is asking whether this adjustment is required or permitted to be made retrospectively. You can go for retrospective amendments, no problem. Ind AS 101 does allow that. But if you do not go for retrospective amendment, you will have to take the value as it is. Are we clear with this? Yes. All right. So that takes care of illustration 4. That takes care of illustration 4. Okay. All right. Okay. It is totally dependent on the date when you select the business combination. Okay. It is totally dependent on the date when you select business combination. Okay. A Limited, come to illustration 5. A Limited had made certain investments in B Limited's convertible debt instruments. The conversion rights or substantive rights would provide A with a control over B Limited. A has therefore evaluated that B would be treated as its subsidiary under Ind AS and hence would require consolidation in its Ind AS consolidated financial statements. B Limited was not considered as a subsidiary, associate, or joint venture under the previous cap. How should B be consolidated on transition to Ind AS, assuming that A Limited has opted to avail the exemption from retrospective restatement of past business combinations? Okay. What do you guys think? A has made certain investments. Those are of a convertible nature. They have now become substantive. They have now become substantive. How should B Limited be consolidated on transition? Assuming that A Limited has opted to avail the exemption from retrospective restatement of past business combination. Yes, A made certain investment in convertible debt and therefore if restated, goodwill, NCI, P&L will change. If restated, goodwill, NCI, P&L, everything will change. Everything will change. Is it okay? From the previous state. From the previous state. Is it okay? Yes. Is it fine? Next. All right. Coming to the next one. Coming to the next one. Acha. If restate with effect from date of transition, then goodwill, NCI, goodwill, NCI from date of transition will be considered. will be considered. Are we clear with this? Yes. So the date of transition will be assumed as the date of business combination. That's right. The restatement will happen effective the date of transition. Are we clear with this? Yes. B will be consolidated from the date of transition. B will be consolidated from the date of transition, and no prior restatement. No prior restatement would be necessary. So that is illustration 5. Illustration 5. Okay. Coming next to illustration 6. A Limited has a subsidiary B. On first time adoption of Ind AS by B, that means here subsidiary is getting adopted. Subsidiary is adopting Ind AS, not the parent. It availed the optional exemption of not restating its past business combination. That means B's past business combination. So A is a subsidiary of B. B is transitioning to Ind AS. So B has subsidiaries S1, S2, S3. All their business combinations will end up getting restated. All their business combinations will end up getting restated. However, A Limited has decided to restate all its past business combinations. Whether the amounts recorded by the subsidiary needs to be adjusted while preparing the consolidated financial statements of A Limited, considering that A does not avail the business combination exception. Considering that A does not avail the business combination exemption. Will the answer be different if A adopts Ind AS after B Limited? All right. Fine. Tell me, see, A has a subsidiary B. B is transitioning to Ind AS, not A. And S1, S2, S3, for example, subsidiaries of B, they are also transition. They are also transition. Yes. Are we clear with this so far? Yeah. Now the question is, whether the amounts recorded by subsidiary need to be adjusted while preparing the consolidated financial statements of A Limited. Tell me one thing, if Ind AS applies to B, does it apply to A? Yeah. This will be our last 2-3 questions. I'll take a break after this question. Then we have 1 or 2 theory questions, and then we move on to practical scenarios. Okay, then we move on to practical scenarios. Because we still have couple of special transitory items left, like government grants, financial instruments. Then you are having, that's what, accounting estimates and investment in intangibles, etc. So all these 2, 3, or 4, 5 items are there. They are small items, but we can complete that. Okay. So now, if Ind AS applies to B, it also applies to A. It also applies to A. And therefore, if A restates business combination, if A restates the business combination, yes, these combinations will need to be restated. Okay. So now let us understand this. This is a little tricky. Yeah. So now we come to illustration 6, because there is one separate provision which is there here, which we have not yet covered. A is there, B is there. B is having its subsidiaries S1, S2, S3. Okay. Now, B Ind AS applies. So B has opted for no restatement of past business combinations. Okay. That means S1, S2, S3. No restatement. ये किसका पॉलिसी है? दिस इज द पॉलिसी ऑफ बी. So S1, S2, S3 combinations will not get restated. Their net assets, their goodwill, their NCI, their post acquisition profits, everything will come and fall into B, and we are going to take that only for the step forward from the date of transition. But there is one more thing which happens, and that one more thing is with B becoming what you can say, with B getting Ind AS applicable to itself, automatically A also is going to apply Ind AS, going to apply going to apply, this is going to have Ind AS. Now, Ind AS, it has opted, but apart from opting, it has also said that A Limited does not avail the exemption. That means plus retrospective applicability. Retrospective applicability. And now the question is, if A decides to apply retrospectively business combinations, do I have to what you can say, do I have to record them? Do I have to record them? Is it okay? So 1, 2, 3, 4. If A adopts restatement, do I have to restate B, S1, S2, and S3? Answer is in the normal cases, yes. In the normal cases, yes. But sir, what is the non-normal cases? Non-normal cases, this one. B ने apply किया, Ind AS first became applicable to B. B has done the adjustments. B has done the adjustments, and now it is coming as a single. It is coming as a what you can say. B has done the adjustments, taken all NCI, goodwill, etc. They are now coming as single line items in the consolidated balance sheet of B. And this is already on the date of transition. This is already on the date of transition. Now, when A applies Ind AS, do you think it is a wise decision to go back in time and restate the business combinations of B and its subsidiaries S1, S2, S3? Yes. Can you say that it is a wise decision? Can you say that it is a wise decision? Because B converged before and B has done the treatment. B has done the what you can say, the treatment of business combination. That means taking its taking its NCI, goodwill, net assets, everything taking into consideration without restatement of past business combination. And abhi, when it became applicable to A, you are now saying that now you do the what you can say, now you do your retrospective restatement. Is it correct? Is it correct is the first question. Yeah. B has just opted for no restatement. So whatever it is there, S1, S2, S3, it will become. But the question is, what about the parent? Because subsidiary got Ind AS, parent also got Ind AS, and parent wants to retrospectively apply. Parents wants to retrospectively reapply. Can B again restate the whole working? Answer is not required. Ideally, yes. Ideally, yes. Karna padega. But in this case, the subsidiary transition to Ind AS first, and then the parent transition, and therefore there is no need of restatement of past business combinations. There is no need for restatement of past business combinations. Are we okay? Because B has transitioned before to A. That one thing is a leverage that is given, that if a subsidiary transits to Ind AS after the uh, what you can say, if subsidiary transits to Ind AS before the parent, then whatever is the subsidiary value of business combinations has to be taken by the parent. Has to be taken by the parent. Are we clear with this? No need of restatement. No need of restatement. Are we clear with this? Yes. Are we clear? Namrata, did you follow? Did you follow? So exemption, Ind AS 101 allows taking Ind AS values of D on transition date without restatement. Okay, fine. So that takes care of illustration number 6. Okay, remember this. This is a very specific exemption which is there. Normally, your exemptions under business combinations and all are related to that cutoff date. Any cutoff date you select of your choice, business combination prior to that you will not restate. After that, you will restate all the business combinations. Do not be selective in restating your business combinations. Are we clear with this? Yes. So now we take a 10 minutes break. We shall convene at 9 a.m. Yes, we should be in a position to do some practical problems shortly thereafter, and then we shall wind up the standard. Is it okay? Yes. So 10-minute break, please. We shall convene at 9. Break. Okay. Okay. All right. So we just quickly summarize business combinations and then move further. So business combinations, you have two options. No restatement for past business combinations means whatever is there on the date of transition, you take those values into your Ind AS 10, into your Ind AS financial statements. Do not restate NCI reserves, net assets of the subsidiaries, or your target entities. कुछ भी restate मत करो. What is there on the date of transition, bring it forward, and that becomes your Ind AS values. So no restatement for past business combination. Or secondly, what you can do is restate past business combinations with effect from a particular date. With effect from a particular date. All right. If you take this choice, in case this choice is availed, comma, all acquisitions, all acquisitions after the selected date would be retrospectively restated. However, acquisitions prior to the date need not be restated. Need not be restated. Is it okay? So this is your summary about business combinations. Okay, you can just note this part down. So far, whatever I have given, I hope you guys have already noted, because we had done notes for the first one, that is ESOPs, those three options: vested and exercised, vested but not exercised, not vested, neither exercised. Then we moved on to foreign currency gains or losses. There we did that option one, option two notes. Then in the PP, we have done the deemed cost and retrospective restatement. And now business combinations. So I hope you have taken the notes for all of that. Okay. Okay. Done? Shall we proceed further, boys and girls? Are you guys okay with the session? Yeah, noted. Okay. And then we had done something for PP intangible. Yes, yes, yes. Okay, fine. Fair enough. Noted down, everyone? Yes. Okay. Okay. So that is as far as business combination is concerned. We have one question which is a bit, tricky one. Let us see. Company A intends to restate past business combination with effect from 30th June X0, being a date prior to the transition date. If business combinations are restated, whether certain exemptions, such as the deemed cost exemption for PPE, can be adopted. That is the question. Okay. So now question one, what does it say? See, business combination, it needs to restate. It wants to restate. So when it restates, all net assets, NCI, reserves, etc. will be restated. At the same time, suppose PPE, it wants to take the previous gap carrying amount. Can you see a conflict between both of them again? Can you see a conflict? One side you're saying, I want to take previous gap carrying value. Okay. On the other side, you're saying business combination, I want to restate. So I will not take the previous gap carrying value. I will do a restatement. So दोनों अलग अलग चीजें हैं. One is saying I will not restate. One is saying I will restate. Is there a conflict between both of them? Answer is yes, there is a conflict between both of them. And therefore, how do I interpret this? How do I interpret this? So we interpret this as whatever assets are there under the business combination, you have to restate that. There you cannot go for the previous gap carrying value. And wherever you are having items other than business combination, there you can go ahead and take the previous gap carrying value. So items like contingent consideration, in-process R&D, all these items were not there under AS. If you recollect, contingent consideration हम दिखाते ही कहाँ थे? We did not have a place to show contingent consideration. And then we did not show in-process R&D. So all these things we can show it at fair value in business combination, but in accounting standard, the previous gap value was 0. So therefore, I have to take this in my business combination as part of net assets taken over. I will do a restatement. Why? Because I am restating the business combination. Achha, what if I do not adopt business combination restatement? In that case, you cannot show that and you will continue with the previous gap carrying amount. That means na contingent consideration aayega, neither will you have in-process R&D, nothing will be there. Okay, nothing is going to be there. So business combination, restate, net assets, NCI reserves, etc. everything get restated. Other than business combination assets, you can go for the previous gap carrying amount. Are we clear on this? Yes, are we clear? So this question is also done. Are you following? Yes, are you following, guys? Yeah. Please let me know. Okay. So restatement has to be done if you have adopted it. However, only one case you have an exception where a subsidiary has transitioned to Ind AS before the parent. That time when the parent opts to restate, it need not restate the subsidiary because the subsidiary is already under Ind AS. So that is the one thing which you will have to keep in mind. Okay. Just 1 minute. Business combination was the fourth item which I had. We are two, one, two, five, four, one business combinations. Okay, this statement. Just give me a minute. Okay, yeah. So this takes care of business combination. Coming to fifth one, compound financial instruments. Compound financial instruments. Okay. Yeah. Now, example, convertible debentures. You guys have studied financial instruments. So tell me one thing. What do you do with convertible debentures? What do you do with convertible debentures? सर हम डिबेंचर्स को लायबिलिटी में दिखा देते हैं पूरा. Do we do that? Yes. What do you do with convertible debentures? You can tell me in just 4 or 5 words. What do you do? Convertible debentures. क्या करते हो? Yeah. What do you do to convertible debentures? Do I show it entirely as a liability? Answer is no. You go for split accounting. You go for split accounting, separating liability and equity. Separating liability and equity. Are yes or no? Bolo yaar. We separate the liability and equity. Yes. So therefore, if this liability is outstanding on the date of transition, so instrument issued before transition and outstanding on date of transition and outstanding on date of transition. Yes. So therefore, how do I treat this? How do I treat this? Number one or step one, you can note this down. Step one, find liability and equity component on date of issue. Don't get confused. Students get confused here and say, sir, date of issue, why we should do? Let us go to date of transition and do it. Answer is no. Standard is clear when it says you find out on the date of issue what is your find liability and equity component on the date of issue as per Ind AS 109. Step 2. Find amortized cost. Find amortized cost on the date of transition. On the date of transition. Ind AS 101. Step 3. Find ledger balance as per previous gap on the date of transition. On the date of transition. After considering discount, premium on redemption slash coupon rates, coupon payments. Step 4. Step 4. Eliminate liability under previous gap and replace with equity and liability component as per step 2. Difference होगा if any. Where will it go? Difference if any will be recognized in retained earnings. Difference if any will be recognized in retained earnings. Are we clear? Yes. So what happens is I take the instrument's fair value on the date of issue. I will do the amortized table and arrive at the value on the date of transition. And that value is what I will do the accounting of. Okay. And that value is what I will do the accounting of. The standard says that you cannot take the fair value on the date of transition. Wo mat karo. Do not do that. Then there is no option given here. There is no option given here. You have to go backward. You have to do a retrospective restatement. यही बोलते हैं. This is what is retrospective restatement. Okay. We are going back, calculating the value that should have been, amortizing the unwinding the discount, or calculating the effective interest rate and then charging it off and coming to the current period. That is the date of transition. And the date of transition value is what you are going to reinstate, is what you are going to replace the existing gap value. Are we clear with this? Yes. Okay. Yes. So note it down, everyone. So based on this, let us quickly pick up a question. Okay. So now let us do this. Illustration 15. Mark this as important. Okay. Okay. On April 1, 20X1, Sigma Limited issued 30,000 6% debentures of face value 100 per debenture at par. Issued 6% convertible debentures. The debentures are redeemable at a premium of 10% on 31st March X5, or these may be converted into ordinary shares at the option of the holder. At the option of the holder means what? You have to recognize a liability for the principal also. You cannot say only the interest. बिकॉज कल को होल्डर ने उठ के लायबिलिटी का पैसे मांग लिया यानी प्रिंसिपल मांग लिया, यू हैव टू गिव हिम, सो यू मस्ट हैव a liability for that. The interest rate for equivalent debentures without conversion rights would have been 10%. The date of transition to Ind AS is 1st April 20x3. Suggest how should sigma account for this compound financial instrument on the date of transition. Present value of rupee 1 receivable at the end of each year based on the discount rates of 6% and 10% can be taken as 0.94, whatever it is. Okay. So now let us start. All the data is given. There is nothing that is left. So now let us start. First one, find liability and equity component on the date of issue as per Ind AS 109. So issue proceeds. This is illustration 15. Okay. Now issue proceeds. Issue proceeds equal to rupees 30 lakhs. 30,000 debentures into rupees 100 per debenture, right? Yeah. 100 per debenture. And this is on 1420x1. Okay. So now I need to split this. Now I need to split this. Okay. So let us split it. Liability component, equity component. Acha, equity component will be a balancing figure. So we will have to do the liability component. So total this up, this comes to how much? This comes to 0.91, 0.83, 0.75, 0.68. So this comes. Acha. Hello. Yeah, I hope it got restated now. Yeah. Sorry. I think it is fine now. Okay. So tell me, liability component kitna aega? Are you familiar with this calculation? What we are doing just now? If you are familiar, you should tell me. ₹28 lakh, 14,600. Yeah. So this is what is going to be your liability component. All right. So what will be your equity component? The difference, obviously, the balancing figure 185, 400. Okay. Yeah. So 185, 400. Now this is the value on 1420x1. When am I transitioning? Sir, you are transitioning on 1420x3. So can I directly take these values into the journal entry on the date of transition? Answer is no. Equity to wahi rahega, but the liability component is going to change because of amortization. So you will have to do an amortization cost. Okay. So now let us do the liability and equity component on 1420x3. Okay. Now year opening, effective interest rate 10%, coupon, principal, closing. Year 1, Opening is 28,14,600. So 281,460. Coupon is 1,80,000. So the net closing is 29,16,060. Second, 29,16,060, 291,606, 1,80,000. So this comes to 30,27,666. So as on the date of transition, your liability component has a value of 30,27,666. Equity component, will it undergo a change? Answer is no. 1,85,400. Same as split on date of transition. Same as the split on the date of transition. Are we clear with this? Yes. First step first. Are we clear with this? Yes. Any doubt so far? Anybody? All clear? Yeah. Okay. So now let us come to the treatment under gap. So we have completed step 1 on the date of issue. We have found out the amortized cost, step 2. Now step 3, ledger balance. Okay. Balance as per gap. What is it? See, under the step 1 is not clear. Step 1 we have done na beta. Issue proceeds. This is step 1. Find the liability and equity component on the date of issue. So issue proceeds is 30 lakhs. So liability component, well, I'm paying the coupon at the rate of 6% and I'm redeeming this instrument at a 10% premium. So 30 lakhs into 6% into 3.17 plus 33 lakhs into 0.68. So 28 lakh 14,600 and 185,400. So this is on the transition date 1420x1. And then can I take these values for the purpose of my split accounting? Answer is no, you cannot. You have to take the value on the date of transition, that is 1420x3. And that is why we do the amortization table. So 20x1 to x3 is the time span of 2 years. So x1, x2 first year, x2, x3 second year. And then you do the equity component, which is essentially the same value. Are you clear now? Yes. Are we clear with this? Okay, fine. So step 1 is done, step 2 is done. Now balance as per previous gap. Acha, previous gap, dhyan se suno. I would have a liability of 30 lakhs opening and 30 lakhs would become 33 lakhs. Do you remember this? How did I do this? Sir, I would amortize this on a flat rate. I would amortize this on a flat rate. Discount or premium amortized, I would take it over the tenure of the bond. So the tenure of the bond is how many years? The tenure of the bond is a period of 4 years. That means the net gap 33 lakhs minus 30 lakhs divided by 4 years. Each year I would amortize 75,000 per annum amortized. So that you will ultimately reach that value of 33 lakhs. You will ultimately reach the value of 33 lakhs. So therefore, on the date of issue 1/4/2011, balance 30 lakhs, add premium amortized, which is 1,50,000. Why 1,50,000? This is for 2 years out of 4 years. This is for 2 years out of 4 years. Are we able to follow? Are we able to follow? Yes. So closing balance is 31,50,000. So in your books, you are having 31,50,000 as the balance. This balance has to be removed, and in its place, you should have 1,85,400 and 30,27,666. Okay. So therefore, the entry will be, what will be the entries under the previous gap so far? Interest account debit to bank. 1,80,000. This is done for both the years. This is done for both the years. 20x1, x2 and x2, x3. And then premium amortized debit to bond or debentures account. $75,000. Okay, fair enough. Are you able to understand? So this is the entries which would have been passed under gap, previous gap. Previous gap entries. Okay. And now I have to do the transition. So 1,420x3. The entry that will be passed is convertible debentures account debit 31,50,000 to liability component 30,27,666 equity component 1,85,400. So the difference is 63,066, which goes to retained earnings. Which goes to retained earnings. All right. So now the question is, sir, what is this 63,066? Why do I get this? So therefore, we can just have a look at it. So under Ind AS and AS, charge for X1, X2, 281,460, and this is 1,80,000 plus 1,80,000 plus 75,000. 2,55,000. And then charge for the next year X2, X3, that is 291,606. So this comes to how much? 5,73,066 versus 5,10,000. If I take the difference between these two, it comes to 63,066, which is exactly the value that is there in the difference on transition. That means you should have booked an expense of 63,066 more in the previous years, but because they did not get booked, you are going to take it as, retained earnings adjustment. You are going to take it as a retained earnings adjustment. Are we clear with this? Yes. Right. Yeah, note it down, guys. Any doubts? Shall we proceed further? So that takes care of illustration 15. Okay, I think we've done quite a number of questions in this particular sessions. Okay. Anybody has any doubts here? Done? Yes. Shall we proceed further? Okay. So this takes care of uh, illustration 15. Coming to the next key point, that is investment in joint ventures. Investment in joint ventures. Which standard deals with investment in joint ventures? Jaldi bolo. And how do you account for investment in joint ventures? हाँ बहुत पढ़ लिया बेटा बहुत पढ़ना पड़ेगा अभी आई हैव अनदर 4 cases टू कंप्लीट इन्वेस्टमेंट इन जॉइंट वेंचर हो गया देन आई हैव टू कंप्लीट विथ यू I still have to complete accounting estimate. I have to complete government grants. I have to do, yeah, that was left. Compound financial instruments. Loan from government, accounting estimates. Yes. ये दो चीजें तो करना पड़ेगा. Yes. Yeah. So, Ind AS 111 tells us what is a joint arrangement, right? But if I recollect correctly, it is Ind AS 28 that deals with accounting for joint ventures. Ind AS 27 is separate financial statements. Okay. And Ind AS 110 is consolidated financial statements. Definition is given in 110, elaborated in 111, accounting in Ind AS 28. Please check it up. Okay. I think it is correct what I'm saying. Ind AS 28 MCA. Investments in associates and joint ventures. That's right. अच्छा, joint venture का accounting कैसे करोगे? How do you do the accounting for joint ventures in India? Jaldi, jaldi. See, you have studied business combination just about a month back. Okay, yes or no? Just a month would have been over at the most. Okay, financial instruments would have taken about 15-20 less days, or maybe 30 days, and then the other one would have taken same time. So now tell me. Then how do you account for Ind AS 28? जल्दी बोलो, मेथड का नाम बोलो. You don't have to explain me the method. Under Ind AS 28, I would follow equity method of accounting. I would follow equity method of accounting. कुछ याद आ रहा है? Are you able to recollect equity method of accounting? Yes or no? Equity method of accounting. That is basically your uh, investment, add profit, less distribution, closing balance of investments. So investment would appear in the balance sheet, in the consolidated financial statements. However, under accounting standards, this was covered by AS 27. This was covered by AS 27. How did you do the accounting of joint ventures here? Here you used to do proportionate consolidation. Here you used to do proportionate consolidation. Sir, why did I do proportionate consolidation? Well, you used to take proportionate assets, proportionate liabilities, proportionate incomes, proportionate expenses, and you would get proportionate goodwill thereon. You would get proportionate goodwill thereon. So whether it is joint operations or joint venture, you would always take it as proportionate consolidation under AS 27. But under the Ind AS 28, you are following equity method. So now just imagine a situation. You are having a joint venture under the AS regime. आपने joint venture को proportionately consolidate किया है. You have proportionately consolidated the joint venture in your consolidated financial statements. Now that is presented to you for transition. So now under the revised Ind AS, you cannot do a proportionate consolidation. You have to follow the equity method. That means proportionate assets and liabilities cannot come under Ind AS 28. Instead, only one line, investment in joint venture, will come, which includes investment plus profit share minus any distribution. That gives you the closing. So only one item should come. And here you will be having under AS all assets, all liabilities. So now you tell me, what are you going to do? You are going to remove the assets, liabilities that are coming in the ICAI regime, and you will replace it with the investments. You will replace it with the investments in joint ventures. So investment in joint venture will be debited. Credit will be the net assets, or credit gross assets, debit the liabilities of the joint venture, and then the difference, if any, will go to retained earnings. Okay, and that kind of closes our treatment of joint ventures. That will close the treatment of joint ventures. Okay, so you can note this down. Note these two things. Transition to Ind AS would be as under. Step A, initial investment on the transition date would be the aggregate value of all assets, liabilities, including proportionate goodwill. Basically, what they are saying is you will remove the assets, liabilities, etc., replace it with a single line item, which will be a representative of asset, liabilities, proportionate goodwill, etc. Hoga hi, because what we are doing, investment, add profit, less distribution. So that is nothing but exactly what is your net worth, right? So therefore, that will be the aggregate. And then finally, B, test investment for impairment. For impairment. Test investment for impairment. So that takes care of investment in joint ventures. Let us quickly look at a question. Slightly a controversial question. Okay. I have discussed this. I have gone through the solution, and at one place it's slightly what do I say? Controversial. Okay. All right. XYZ is a company registered under the Companies Act following accounting standards notified under Accounting Standards Rules 2006. Company decided to voluntarily adopt Ind AS. Whether you voluntarily adopt, mandatorily adopt, Ind AS 101 will be applicable. So therefore, you have to follow 101 principles. With effect from 1st April X2, that is with the transition date of 1st April X1. Company has a wholly owned subsidiary and one joint venture, which are into manufacturing of automobile spare parts. The consolidated financial statements of the company under Indian GAAP are as under. So you are given shareholders' funds, share capital, reserves, long-term borrowings, provisions, long-term liabilities, trade payable, short-term provisions, non-current assets. You have PPE, goodwill on consolidation of subsidiary and joint venture, hoga investment property, long-term loans and advances, current assets. You have trade receivables, investments, and other current assets. Additional information, the company has entered into a joint arrangement by acquiring 50% of the equity shares of ABC Private Limited. Presently, same has been accounted as per proportionate consolidation method. The proportionate share of assets and liabilities of ABC Private Limited included in the consolidated financial statements of XYZ is as under. So you are having these investments. The investment is in the nature of joint venture as per Ind AS 111. Suggest the accounting adjustments required to be made in the opening balance sheet as on 1st April 20X1. Are you okay? Just go through this question once. Yeah. All right. Now, what am I supposed to do? These all things are there. Okay. The company has entered into a joint arrangement by acquiring 50% of equity shares. These assets and liabilities are included there. Accounting investment is in the nature of joint venture. Suggest the accounting treatment required to be made in the opening balance sheet as on 1st April 20X1. All right, fine. Now see, in this balance sheet, I am having these figures. This is what they have given. Okay. All right. Now नहीं थोड़े से एटलीस्ट मेथड्स आई हैव टू डिस्कस श्रुति बाकी का आई ट्राई आई हैव टू कंप्लीट दिस स्टैंडर्ड टुडे okay I have to complete the standard today because tomorrow maybe we can pick up analysis of financial statements and then we can pick up a couple of questions from here, but today we are going with completion of this standard at least on a theoretical basis. Okay, yeah. So now just I will run you through the way the solution has been done. Slightly controversial hai. It is not exactly an ideal standard which I would like to say. Okay. And I will give my reasons also for saying so. Okay. Uh, क्योंकि it's not very nice on the face of it. Okay. Uh, but that is the arithmetical part. Conceptually, the question is sound. Let me be very fair on that also. Conceptually, question is right. Conceptually, it has discussed what needs to be discussed, addressed what needs to be addressed, followed the standards that need to be followed. Only computational part, there is a slight controversy. Otherwise, the question is perfectly fine. Okay. So now, see, these items are all included in this balance sheet. Okay. Now, under Ind AS, can I include these items there? Answer is no, you cannot. Sir, why? Because under Ind AS, you follow equity method. Sir, यहाँ पे, this is AS balance sheet. You can look, you start with shareholders funds. So this is the balance sheet under Indian GAAP, not Ind AS. And therefore, you cannot say that this is also equity method. No, this is proportionate consolidation. These items are linked there. These items are linked there. So what you have to do is you will remove these items. Remove these items and replace with investment in ABC Private Limited and replace with a single line item investment in ABC Private Limited. Okay. So what is going to be your entry? Your entry will be, this is question 5. Your entry looks something like this. Your entry looks something like this. You will have investment in ABC debit to कौन से एसेट्स हैं? पीपीई, लोन्स एंड एडवांसेस, ट्रेड रिसीवेबल्स। ट्रेड रिसीवेबल्स, अदर करंट एसेट्स, then you will be removing trade। और कौन सा है? शॉर्ट टर्म प्रोविजंस। डेबिट एंड गुडविल भी जाना चाहिए। या so I'm removing all assets and liabilities and replacing it with investment in ABC. Okay, so if you quickly help me with the figures: property plant equipment 1200, 405, 280, 280, 50, 75, 35. Now the question is, sir, what is going to be my goodwill? Look at the question. Sir, do I have goodwill? Yes. Goodwill is on consolidation of subsidiary and joint venture 1507, 1507. That means, do I have the split of this goodwill? Answer is no. कितना subsidiary का है, कितना joint venture का है? I do not have any clarity, and therefore they are doing an allocation of 1507. They are doing an allocation of 1507. Okay. How do I do that allocation of 1507? And that is something which is uh, not something I would like to see. Okay. All right. Now, question 5. Okay. Okay. So now the question is, how do I calculate the goodwill? So therefore, the goodwill that they are calculating is on an allocation basis. Is on an allocation basis. Acha. How do I get the allocation basis is the next question. So they have done this 1507 total goodwill. 23,137 they have divided it by and multiplied it by 1825. So what are this 23,137 and what is 1825? Let us quickly have it done through. Okay. So now okay. 1507 is the goodwill for the entire balance sheet. So they have picked up the entire balance sheet. So 22 यहां से स्टार्ट करते हैं. So 22,288 plus 5245 6350 plus 1818 1818 plus 104 minus 8455 and 475 minus 475 plus 1507 and then into 1200. This is basically the joint venture assets and liabilities. 1200, 405, 280 plus 50 minus 75 minus 35. This is the basis of allocation they have used. This is the basis of allocation they have used. So this comes to 1.1507 into 1825 by 23,137. Okay. Now there are a couple of issues. If I have to allocate goodwill, how can goodwill be in the denominator? See, I have to divide a particular item in the ratio of x is to y. That same item cannot be a part of x is to y. It has to be out of that. So first controversy is putting 1507 in the denominator. Putting 1507 in the denominator. The second thing, and this is the more intriguing one, or the one that is more questionable, is they have taken only these assets 1, 2, 3, 4, 5, 6, 7, only these assets and liabilities to belong to that of the subsidiary. If you see, nowhere we have taken long-term borrowings, long-term provisions, other long-term liabilities. We have taken only these two, and we have taken 1, 2. We have not taken 5, 2, 4, 5 also. We have taken 1, 2, 3, 4. Why this? Only those items which are there for the joint venture has been considered to belong to the subsidiary also. अरे ऐसा थोड़े ना होता है. It does not happen like this. Okay. Who has told that जो asset subsidiary के है वही asset joint venture के रहेंगे? Who has said that what will be the composition of the joint venture will be the composition of the subsidiary? Nobody has said that. And if nobody has said that in the question here, then it would not be right to take only these items. That is why your investment is left out. That is why you are left out with your long-term borrowings. That is why you are left out with investment property. This is the second thing. First thing, goodwill is taken in the denominator, not required to be taken. Second thing is, these items are all missed out. These items are all missed out for reasons saying that those joint ventures assets and liabilities will also be that of the subsidiaries assets and liabilities. So this is the second reason. Third reason is by virtually saying that 22,288 belongs to joint venture and the subsidiary, iska matlab parents assets are probably not even included here. Parents assets are not even included here. And therefore, it becomes a problem. Therefore, this question is a little bit off track. It is a little bit off track, but this is only mathematical problem. This is only mathematical problem. It is not actually a, what you can say, a conceptual problem. So they could mitigate this by just giving the dividend on, by giving the, what you can say, by giving the goodwill on the joint venture separately. If they had to give the joint venture goodwill separately, we need not have done all of this. Okay. But वो दिया नहीं है. That is why we are partly taking some things, partly taking something else. So there are three controversial areas here. First one is goodwill included in the denominator, which is not permitted. Second one is assets and liabilities corresponding to those which are there in the joint venture, only those are considered, not the entire subsidiaries assets and liabilities. And third one, if we are assuming everything from the balance sheet of joint venture only, then there are no net assets of the parent. Only the joint venture and the subsidiary, if we end up assessing, there will not be any, what you can say, there will not be any net assets of the parent. Because now the treatment dekhoge, so it appears that only the, it is assumed that only the joint venture and subsidiaries assets are there, not of the parent. Okay, so that is the third reason why this solution is not pretty consistent. Okay, so anyways, that is seventh one. So if you solve it, what are you going to get is, yeah, if you solve it, what are you going to get is, you will get goodwill of 119, and finally you will get investment in ABC 1944. Investment in ABC 1944. And this 1944 is what will go in the balance sheet, and all these items will get eliminated from the balance sheet. All these items will get eliminated from the balance sheet. Ignoring the concept, the calculation part, this is exactly how it will happen. I'll just get my charger. Give me a minute. Yeah. So did you understand the question? Yeah. At least conceptually, are you able to follow? Yeah. Calculation में there is a problem, I admit, but are you okay with the question per se? Did you understand the concept? Yeah, because that is more important for me. Yes. See, this goodwill split 1507 should be split between subsidiaries goodwill, joint ventures goodwill. How do I do this split? Ideally, the joint venture goodwill and subsidiary goodwill should have been given in the question. If it was given in the question, the split would not be required. We would just take these assets, liabilities removal, and in its place investment in ABC and closed the question. But यहाँ पे वैसा दिया नहीं है. So what they are doing is they are taking it as 1507 multiplied by net assets of joint venture divided by net assets of joint venture plus subsidiary plus goodwill itself. Now I have a problem with this. First one, goodwill again cannot come in the denominator. So वो आ गया है. So it should not come in the denominator. It should be 1507 into net assets of joint venture divided by net assets of joint venture plus subsidiary. This is the first point. Second point, do I have net assets of joint venture and subsidiary given to me? Yes. Answer is no, you haven't. This is the consolidated financial statements. Whose numbers will be there here? Ideally, the parent, the subsidiary, the joint venture. All the three should be there here. But यहाँ पे by saying that 22, 288, 63450, 1818, All these when we are taking in our workings, then what happens is you are not going to take, I mean, you are not going to give a correct value of the assets and liabilities. Because as of now, by taking 22,288, 1818, 6350, etc., what you are implying is 22,288 is only of the subsidiary and the joint venture. Parent ka assets hai hi nahi. You are doing the same thing for long-term loans and advances, for trade receivables. Everything you are saying that the joint venture and subsidiary only looks after the parent does not have any assets and liabilities of its own. So this is the second problem. And the third problem that I am having is uh, the third problem that I am having is all assets and liabilities are not considered. I am considering only those assets and liabilities which are there of the joint venture. Sir, is it always necessary that subsidiary will have the same assets and liabilities as a joint venture? Answer is no. Subsidiary alag hai, joint venture alag hai. Subsidiary can have its own assets and liabilities. And joint venture can have its own set of assets and liabilities. That part is also missing, which is why these items are not coming in the working. Are we clear with this now? Yes. So for these reasons, the questions manner of solving is not right, but conceptually, yes, they are correct. Conceptually, they are correct. Are we clear with this? Yeah. Are we clear? Any doubt? No doubt. Clear? Okay. So that takes care of question number 5. Okay. Coming to the next two small topics. Okay. Loan from government. Okay. This is sixth one हो गया. Now seventh one. Below market rates. Okay. For government loans. Okay. Prospective application. Prospective application. Retrospective. Retrospectively restate. Okay. Record loan or liability as financial liability or equity as per previous gap value. Grant not recognized for benefit arising for the benefit arising due to below market rate of interest. That means no split accounting, no split accounting as per Ind AS 20, Ind AS 109. No fair value. Coming to retrospectively restating, then go back to original date of loan and recalculate the financial liability and grant component. And recalculate the P&L and grant component based on, yes, based on fair value. Based at fair value. Okay. Loan amount amortized as financial liability and amortized as a financial liability and government grant transfer to P&L deferred government grant, or third one is deferred government grant, or third one is cost of assets. Are we clear with this? Yes. Loans, loans below market rate of interest, when we do the split accounting at fair value, it goes and sits as a liability. There will be an effective interest rate which we will get and which we will have to pay. Yes, coming to the next one, that is the government grant. The balancing figure will be the grant amount. This grant is what is going to go to your P&L if it pertains to past conditions which you have fulfilled, or it is unconditional, number one. It will go to the deferred government grant if it is pertaining to something that it will go to a deferred government grant if it is pertaining to uh, uh, an income which is subject to fulfillment of certain conditions. So you can put it under deferred government grant. Or third one is you will have to adjust it against cost of assets if it is a grant for the purpose of acquisition of property, plant and equipment. So this you will do only if it is retrospectively restated. Otherwise, there is no need to do this. Are you clear with this? Yes. Yes, everybody is clear. Yeah. So that is number 7. And then number 8. measurement of financial instruments. We have done compound financial instruments. This is in general financial instruments. If effective interest rate can be computed retrospectively. If EIR can be computed retrospectively from date of instrument itself. If EIR can be computed retrospectively, restate retrospectively and determine carrying value as per Ind AS 109. And if it is not possible, if computing old EIR is impracticable, then fair value on date of transition to be considered as new carrying value. That is if we cannot compute the old EIR. Okay. Because sometimes these government loans are quite old, so we would be unable to get the exact EIR. So in that case, the date of transition itself take the EIR and finish it off. Are we clear with this? Yes. Are we clear? Measurement of financial statements or financial instruments. Yeah. Note it down. ज्यादा नहीं, थोड़ा सा और. कितने बजे? 11 से ना? हाँ, बस थोड़ा सा और. ठीक है. ओके. Is it clear? Have you noted this? Yeah. This is measurement of financial instruments. That what we discussed was compound financial instruments. Okay. So here, basically in your financial instruments, what is important is no previous gap value is permitted. No previous gap value is permitted. Okay. So therefore, you either go retrospectively, do the fair value, compute the EIR, come to the current date, do the amortization table, and then take the impact on the date of transition. If that is not possible, date of transition ko hi you do the EIR working and then take the amount into your what you can say, take the amount into your transition balance sheet. But you cannot take previous gap value. You cannot take previous gap value. However, in the case of government loans, fair value option is not there. You either go for record the benefit as per the previous gap value. Grant will not be recognized. Grant not recognized, obviously. Grant not recognized for benefit arising due to below market rate of interest. Or alternatively, go back in time, recognize the EIR, calculate, and then you take the difference to your government grant, and then you do the accounting accordingly. So government grant, no fair value, and financial instruments, no previous gap value is permitted. Are we clear with this? See, today you may be in a position to understand this, but in the future, what will happen is you may get confused कि previous gap कहाँ पे applicable होगा, previous gap कहाँ पे applicable नहीं होगा. So previous gap could probably be applicable here. It would probably be applicable for fixed assets, but you'll end up getting confused saying that वहां भी है तो यहाँ भी होना चाहिए. So that is the reason why you have to be very careful when you do this transitions. Okay, coming to the last one, that is estimates. Well, when we talk about estimates, the thing is, see, I would have taken certain estimates on the date of transition, prior to the date of transition. Now, my Ind AS moving to Ind AS happens 2 years after the old financial statements. So, though you have a provision or at that point of time, now you are having certain additional information relating to those provisional items. And therefore, do I have to change those estimates? Answer is no. So, do not change those estimates. Because if you change those estimates, then whatever gap is there, that will go and sit under retained earnings. In fact, it should go and sit in the profit and loss account of the respective previous year. Okay. So no benefit of hindsight can be given in estimates. Okay. So that is the only thing which is left, which was there to tell you. Okay. Now we have a couple of questions to do. It would be helpful. It would be helpful if you at least read the questions and come. If you at least read the questions and come, so that we can be well prepared for the discussions. Okay. So coming to 32, this question. Okay. Illustration 16. Read the question because these are very big and huge questions. Okay. Coming to the next one, illustration 16 is done. Then we move on to illustration 17. Question 17. Okay, so this one also, please read the question and come. You will also probably come up with the solution also. You will also probably come up with the solution also. Okay. Okay. Next one. Yeah, I think these are the only major questions which are left out now. 1, 2, 3, 4, 5, 6 also we have done. Yeah. Go through this question and go through the two questions what I have told you. I think that kind of almost winds up in days 101. Yes. Anybody has any doubts in this standard so far? Yeah. Anybody has any doubts? Any clarity needed? Was it too fast? Was it too haphazard? Was it too difficult, or was it okay? Come on, tell me. Things are clear till now? Things are clear? Maybe tomorrow one more question we do and then you should be fine with that. Okay? But are you okay till now? बोलो यार, इतना भी चुप नहीं रहने का. Yeah? Are we clear so far? Any doubts? Any question? Any topic? Anything in 101? Anything to tell? All clear? Okay. All right, fine. So what we'll do is tomorrow we have an evening session. Yes, I'm there to spoil your Sunday again for you. Okay. So we will do maybe one or two questions from here. Read those long questions and come. Okay. Read those long questions and come. And then, we will pick up analysis of financial statements. Okay. So with that, I think your accounting standards, I mean, your financial reporting paper comes to a close. Okay. All right. Fine. Thanks, everyone. And see you guys tomorrow. Okay. Anji, session.